Good afternoon, morning, evening to everybody. Um, we are here to have a virtual fireside chat with Raghu, who's the CEO of FalconX. The context of this fireside chat is off the back of all the movement that we see in the market around cryptocurrencies. Seems like the space is kind of growing up. And when these things happen, it's great to speak with people that are like on the thick of it. So, just by way of introduction, my name is Stephen Koch. I'm an associate director at the Boston Consulting Group from the London office. Amongst other things that I do, I'm one of the global experts in blockchain, which is a space that I've been playing the last 10 years, and specifically within the world of decentralized finance, cryptocurrencies, and more recently around the place on CDBCs. So, Raghu, would like to introduce yourself?
Thanks so much for hosting, Stephen. Really appreciate it. A quick personal introduction on my side, and I'll give you a little bit of context about FalconX as well. I'm the co-founder CEO for FalconX, and I started my career as an engineer. I specialized in machine learning. Right after that, started two companies, got very successful, got lucky with both the companies, two successful exits. Right after that, went to Harvard Business School. Once I graduated, I got the opportunity to work on Sundar's team at Google. Sundar, who is now the CEO of Google and Alphabet. At that point, he was on the Chrome side of things. And my charter specifically was to drive efforts on a product called Chromebooks. Essentially, these are laptops powered by Chrome, the browser. We got incredibly, successful in U.S. schools, and that taught me firsthand on how to build billion-dollar products and lead teams through this massive scale. So it was a lot of fun. Through some of the brightest engineers that I know at Google, I got exposed to blockchain and Bitcoin. And once I, fell in love with the technology and what that could potentially mean to the world, I got really excited, and we started FalconX about 2.5 years back. And FalconX, in a nutshell, we're one of the fastest growing fintechs and one of the largest digital assets prime brokers in the space. Specifically, what that means for you is we are institutions only. And for institutions, we help you all the way from what is this Bitcoin thing? And what does that mean as the world evolves to how do you actually get exposure? And how do you custody, and what are the safe best practices around custodying? How do you settle once you get exposure to Bitcoin? And after that, can you earn yield on Bitcoin or your US dollar? So we help institutions through their entire life cycle of their digital asset needs. So we're very fortunate to be one of the largest one-stop shops in the industry.
Thank you, Raghu. And your experience is fascinating and to a large extent envious. You've been in several such interesting parts of the industry. And yeah, I think FalconX is an interesting story because of that kind of one-stop shop, logic that it has. And, when you come from this institutional space, that's kind of the expectation you have when you want to play. So that's, what brought me close to you. And that's why I'm so excited about learning from you. So maybe let's just start from the top there, because I just mentioned in the beginning, there's a lot of movement in the market. So what do you see? What do you think? What is happening in the crypto market recently?
Yeah, very interesting last 1 year, especially with the pandemic. I think the whole digital asset adoption, specifically Bitcoin adoption, accelerated by at least 2 to 3 years. As the world is printing money, we're printing anywhere from $6 to $8 trillion. And what that means is the weighted average global inflation is going to be around 5 to 7% for the next 3 to 4 years. And as the macro backdrop of printing is happening, a lot of institutions believe that Bitcoin is a relatively good inflationary hedge. And that is one narrative that is shaping up very strongly in the industry. Specifically, the U.S. started, increasing the M1 money supply around the March of 2020. Around the April-May time frame, Paul Tudor Jones, who is the father of modern hedge funds, he mentioned that he's taking Bitcoin exposure and for the thesis of it being an inflationary hedge, and he compared it to Bitcoin, in the similar stage as what gold was in 1970s. And that really unleashed a wave of U.S. institutions. So we started seeing a very diverse set of U.S. institutions come in, beginning May, and the numbers just exploded. And around the November timeframe, we started seeing the Asian institutions coming in big numbers. And beginning of this year in January, that's when retail started coming in. So the COVID and associated money printing really accelerated, Bitcoin adoption in a summary.
Got it. And then the natural question follows, which is this yet another one, like another bull run or cyclical run, or do you think, this time is different, and if so, why?
Oh, that's a fascinating question. I think we're seeing, unlike the 2017 run, we're seeing a fundamental shift and more sustainability this time, Stephen. To be very specific, Niall Ferguson, who is a professor at Stanford, he claims that pandemics usually give birth to new and improved financial rails, and that's been the case for the last 3, 4, 5 times world's seen this amount of disruption. So on the heels of that theory, what we're seeing, we already spoke about the inflationary hedge. The second thing that a lot of institutions, right? I mean, the Fortune 1000 companies, the hedge funds that we're speaking with, they are beginning to also talk about, Bitcoin specifically being a nice, geopolitical risk hedge, especially if there is trade policy friction between the US and China, which is expected to basically flare up under the current administration. They, historically, at least in the 2019 period, we've seen Bitcoin do well when the trade policy friction flares up. So that is another reason. But more importantly, what is the fundamental shift that I'm referring to? If you look at it, the one of the underlying themes of this run is tokenization of real world assets. So there, US dollar is getting heavily tokenized by 1:1 pegged cryptocurrencies called stablecoins. So essentially, USDC is a stablecoin version of US dollar, which is pegged 1:1. And we see a lot of institutions getting comfortable and using USDC instead of USD. So the tokenization of real world assets, and most of these institutions getting operational comfort around using digital assets like Bitcoin, those I think are fundamental shifts towards sustainability in this bull run compared to what we've seen in 2017.
Yeah, I think you're right. And if you think about this strategically, there's that operational capability test is something to consider, right? Because then there's a number of end states. Not all of them are necessarily Bitcoin.
Yeah.
Especially when you start seeing some companies are playing into this space. You could always fast forward and say, okay, well, if you really start having CDBCs, central bank digital currencies play out in whatever shape or form, then you need to be operationally ready to entertain those, right? And that is something to kind of take into consideration as well. Now, this is very insightful. And now, if I start to, look at this in very recent times, how you've seen it evolve? Like, because you've been doing this for quite a while already, even though in the grand scheme of things, short in the world of cryptocurrencies, it's almost like dinosaur times. So what have you seen since then, and kind of that merit kind of actually getting treasurers and institutional getting doubling down on this?
Yeah, I mean, what we've been seeing over the last 2 years is, as I mentioned, some of the dynamics of first institutions in crypto, like 2.5 years back, was all crypto native, meaning funds that are started in crypto and completely focused on crypto. That's how the institutional side of the space started. Now, as what we were discussing just a little bit before, in the early part of 2020, we've seen a lot of traditional institutions come in. But more importantly, one of the big changes that we are seeing on that front is the diversification of institutions that are coming in. Yes, in the very early part of 2020 was all traditional hedge funds that are coming in, traditional prop shops that were coming in. But now we see insurance companies like MassMutual, corporate treasuries like MicroStrategy, Tesla, and a whole bunch of corporate treasuries are in conversations with us. So we've seen a lot of corporate treasuries coming into the space. Which is a very, very big shift. And the underlying themes we spoke about, Bitcoin as an inflationary hedge, a geopolitical hedge, stable coins, and the tokenization of real world assets. We're also seeing use cases like, institutions are beginning to dip more deeply into Ethereum, not just Bitcoin anymore. So that is one trend that we're seeing. The second thing is crypto as a transmission rail for cross-border payments, and that is another change that we're seeing. We're fortunate to see some of the largest payment providers, use the liquidity on FalconX, and when we see the data, it is amazing, right? I mean, literally, the largest providers in Africa, Philippines, Indonesia, and some of them in the US, they're doing 20 times more volume on crypto than what they did literally 8 to 9 months back.
Yeah. And the cross-border payments is interesting because it's not about the technical functionality, which what people got used to before. It's about the liquidity pools, right?
Right.
And this really play a role. Now, I want to kind of go back to kind of a couple of things that you mentioned. If I'm a treasurer, why would it start allocating, and what do you need to care about beyond what you mentioned around kind of inflationary hedge?
Yeah, I think to calibrate, we've seen corporate treasuries all the way from Fortune 500, Fortune 1000, G2000, and a whole bunch of private companies thinking about exposure. Uh, I would want to calibrate what they mean by exposure, because there's a very diverse narrative that's out there saying that corporate treasuries are putting a whole portion of their balance sheets on Bitcoin. That's not true. What we've seen is most corporate treasurers who are coming in to get exposure to Bitcoin are considering 1 to 2%. Yes, I mean, there is the Teslas of the world considering who has taken 8% exposure, but that is far and few. Most of them are considering the 1 to 2% exposure. Now, why are they considering it? Definitely, inflationary hedge is one major argument that they all cite. The geopolitical risk hedge, which we already discussed. The third thing, which is becoming increasingly evident and the prime and center of the conversation, is yield generation. Literally, if you look at it, $1.8 trillion worth of cash is sitting with S&P 500 companies. And what that means is, if you're getting into this regime of inflation, your money is not actually put to work. If you go to a commercial bank, you're talking about 80 to, at the very most, 180 basis points of interest rate per year. But if you leverage what's happening in crypto for your US dollar, you can now see about 5%, 5.5%. So 550 basis points in comparison. So those are the three reasons why corporate treasurers and treasuries are definitely looking into digital assets, starting with Bitcoin, Ethereum, and also using US dollar to basically generate yield.
Interesting. So, where do I start? So if I'm a treasurer, right? How do I think about this, and kind of what are the considerations I need to take into account?
Yeah. What we've been hearing as we engage with a lot of these treasuries, they want to understand the what first, very, very well. Then they want to understand the how. They want to get to the when. So we can probably go in the same sequence, Stephen. First and foremost, I think a lot of corporate treasuries, I mean, the very early ones that we've interacted in the October, Novembers of the world, it used to be, okay, tell me about Bitcoin. I don't know anything about Bitcoin. Let's start with what is Bitcoin and what does that mean? So, but now we see corporate treasuries, definitely more sophisticated in their understanding of Bitcoin. But it always starts with why Bitcoin, what about Bitcoin that is important to have exposure. Beyond just Bitcoin, can we generate yield? So the first part is like what we spent a lot of time. And thankfully, rather than doing months and months of copious research, any great brokerage out there or a one-stop shop out there can really help you compress that research window from 3 to 4 to 5 months to literally 2 hours, 3 hours of conversations. Why Bitcoin? Who else is doing it? How are they doing it? All of that can be really compressed in that 2 hour window. Now, the second thing, once the what is very, very clear, then we get into the how and the mechanics of it. So that is where I think it truly is very important to find a provider and a partner that can really collaborate with you in terms of thinking about it end to end, all the way from what percentage of your balance sheet will you be having exposure to digital assets like Bitcoin? Are you also considering Ethereum? Or what percentage of your balance sheet are you thinking about yield generation? So that is the first set of questions that we answer. Let's say, once that is defined, The second thing is there are various types of exposure, right? I mean, do you want synthetic exposure to Bitcoin through futures, or do you actually want to have physical, meaning? Do you want to buy Bitcoin itself? So that is the second part of the how question. The third is what are the order types, right? I mean, what is the time period in which you want to buy? Do you want to, discretion is extremely important for all these corporate treasuries. Single most important thing for all of them. So how do you actually make this purchase very, very discreetly? And after that, then we'll get into once someone procures Bitcoin, then we'll get into the when part of it. When do you trigger this execution? How do you custody it? And how do you settle the trade? All the mechanics we then get into it after the fact.
Now, this is right. Getting back to this, a matter of size at the end of the day, right? So if you say that the allocations are on 1 to 2%. So if I'm sitting on 5 billion quid, basically that means that it's $50 million that I want to put there. Now, if if I don't know this market, and I'm used to, what I see in the news or what I see in the market, like that seems like a bit of okay, is it that even possible to do? The answer is probably yes. But what do you just walk us through kind of how do I execute? I want to expose my, 50 million quid or 1% of my balance sheet into this. How does that play out?
Yeah, we've been getting that question a lot, Stephen. So I think that'll be very useful to walk through some of the mechanics. Once you decide that, as an example, you want to get $50 million, you want to buy $50 million of Bitcoin, the three variables associated with it. First and foremost, when do you want to initiate the purchase? Right. I mean, if you have a specific preference of getting internal approvals, bringing out the custody part of it, if you're like, okay, let's make that transaction after 2 weeks, that's the first question. The second thing is, over what duration do you actually want to make the purchase? Because if you go to market, especially with $50 million plus, yes, I mean, unlike the equities, which are very dense, the order books and the trading volume is extremely dense. Crypto's trading volume is not as dense as traditional equities yet, because it's an emerging asset class. What that means is you're not going to place a market order for $50 million, or you're not going to basically put a resting limit order of $50 million, because that'll move the price in the market, which works against you. So the best way to handle it is, the second aspect is the $50 million, let's say we decided to purchase that together after 2 weeks. The most important thing to figure out is what's the time horizon of purchasing. So purchasing it over a period of 1 hour is very different from over 24 hours or 48 hours, especially for a $50 million clip. Based on today's market conditions and the trading volume, we don't want to basically go over 2% of the trading volume. So I think $50 million can potentially be done without affecting the market in 24 hours based on today's conditions. So we work with you, whether 24 hours, 36 hours, 72 hours, whatever is the right window for you. And once we get that calibration, we use any good provider uses a flavor of what we call as TVAPs, right? Time weighted average pricing. And to basically buy small chunks of Bitcoin over a period of time without affecting the market, so that your privacy is preserved. And the second thing, you get a nice, clean, time-weighted average price rather than falling to the prey of the local maximum or the local minimum for the day. So that is how we typically think about the $50 million. And once the trade is complete, then the choice is completely yours, right? I mean, you're sitting on $50 million worth of Bitcoin. You can choose to get yield on the Bitcoin that you purchased, or you can simply choose to custody it, without generating yield. That is again a decision that corporate treasurers vary.
And what role do you play here? Because custodianship in this context is different than what you are typically used to in other asset classes, right? So what role do you play, and then how do you actually execute your yield capabilities then?
Yeah. So from a custody standpoint, we have two flavors. If as a corporate treasurer, if you have decided on a custodian that you want to work with, we work with every major custodian that's out there in terms of basically, receiving Bitcoin, sending Bitcoin. Basically, the settlement operations with any major custodian is already established. So that is one modality. The second, which is the more common modality, is a lot of treasuries come to us and is like, hey, help us make the custody decision. Because we are we have sizable assets that we deal with on a day-to-day basis. So we vetted a whole bunch of custodians for their security, their infrastructure, their reliability, and also the track record of how things are getting done. So we have a 40-page document that talks about all these vendors in detail. So we can help you, pick one of the custodians. And once we pick a custodian together, I think we integrate with them seamlessly so that for you, it is a very simple experience, as simple as over a call or over an email. We can establish a bunch of security checks. Two out of the three people within your firm needs to communicate. Once that communication happens, we take care of everything, including purchasing Bitcoin, pushing it to the custody, establishing the controls for your custody. We help take care of all of that.
Got it. And you kept on coming back to yield, which is absolutely interesting, especially if you're offering a counterparty that can offer the liquidity, so it's kind of cash-like solution. So what could you elaborate a bit more on that? Like, what assets, is that available for? Like, what is the typical kind of API that you get? What within the extent that you can share?
Yeah, absolutely. So I'll break that question into two aspects. The first aspect is how do we generate yield? And the second thing is what are the assets that are available for yield generation? So essentially, any commercial bank, any provider that's basically paying you interest rate, they're figuring out how to basically earn that or higher in terms of interest rate and then pay you back. So the mechanism that FalconX uses to generate that yield is there are a lot of traditional hedge funds who offer us over collateralized positions, and they want to delay those positions by so instead of a T+1 business day settlement, they choose to delay those settlements by up to 20 days. Now, these are completely over collateralized positions. If you take an over collateralized position and then delay it by 20 days, each day I have the opportunity to charge a variable interest rate for the opportunity for the customers who are expressing a view in the market to delay the settlement. So I make money, given where the crypto markets are, for these over collateralized loans. I make an interest rate which is so much bigger and better than the traditional markets. Now, for me to fuel those positions, if Stephen, as a corporate treasurer, wants to put the $50 million Bitcoin that he just purchased right now to work, I use that to basically underwrite the over collateralized positions that my other customers are taking, generate a yield, and give it back to you. So the risk profile on this is again, these are over collateralized positions, institutions only, and with a track record of trading with us over a period of time. Now, what are the assets that we support? All the way from US dollar, Bitcoin, Ethereum to other assets, we basically can provide yield on any of these assets. The most common form factor is US dollar. A lot of some of the corporate treasurers are sitting on $100 million of US dollar. Can you give us a yield? As of today, the rate is somewhere between 5 to 5.5%, APR for US dollar, and we've been sustainably doing that for about a year now. The second is Bitcoin and the digital assets, Bitcoin and Ethereum being the most common ones for yield generation. So there you see a rate of anywhere between 2 to 3.5 or 2 to 4%, depending on the market conditions, Stephen.
That's very interesting, and ultimately, is securities lending, right? In plain vanilla terms, that's super clear. Now, beyond we covered a lot of ground in terms of operationally, how do you get from nothing to kind of exposure and even yield generation? How do I make the decisions around here on the basis of risk? What do you take into account?
Yeah, I mean, just got off a call with a corporate treasurer who asked the exact same question. How should I think about risk overall? I would say there are three buckets, Stephen. First and foremost is the technical security side of things. Crypto, with all the benefits of being an extremely fast 24/7 global decentralized rail, one of the things that you got to be extremely cautious in crypto is the security side of things. So each Bitcoin is held by something called a private key, and a public key and a private key. If someone loses the possession of the private key, it's very difficult to recover the Bitcoin that you hold. So while it might seem scary, in 2014, 2015, 2016, yes, it was really scary to hold Bitcoin. Now there are excellent topologies to basically make it very safe and secure to basically handle Bitcoin. But getting into the details and understanding about the technical security, how is it stored? Where is it stored? Who has the access within the company that you're working with? And who has the access within the corporate treasury function that you have within the company? So those specifics are very important because technical security is like extremely important. Number two, it's very important as you're thinking about a service provider. It's very important to understand the scale of operations, right? I mean, yes, there are like newer players claiming to do some of this, but their volumes and the scale of operation is very small compared to some of the more established players. For example, we do well over $5 billion of transaction volume on a monthly basis. What that scale gives you is comfort that the operational processes behind it are time tested, established, and bulletproof and audited. And that is very important. The operational aspects of how do you actually work with a client? I mean, how do you set expectations correctly? All of that stuff. The third aspect, which is also very, very important when you're considering this, is the discretion part of it. You do not want a news article before the time when you want to announce it yourself, because there's as you can see, there's so many crypto narratives that are extremely hot in the market. Everyone is looking to seize the moment on a narrative. Discretion is something that you got to take very, very seriously. Otherwise, there are big implications to how a company is perceived because of some of the digital asset exposures. So I would say these are the three things that I'd strongly recommend you consider when you're thinking through a vendor.
It's interesting because basically, ultimately, at the end of the day, if you think about the description you made for treasury around like trade life cycles, around yield generation, around risk security, ultimately, as a treasury, is what I would expect from any asset class, right? And so I personally feel I learn a lot from this. And if I maybe synthesize just to see if maybe I made a mistake or misunderstood something, there's a couple of things that come out of this conversation. So the first one seems to be that the market and the asset class in its general sense, not just because of cryptocurrencies generally, is kind of growing up, and and for institutional investors to get into this game, they need to have a service in logic which is a key in other asset classes. So it shouldn't be more or less more complicated or different than it would be in asset classes, right? There's typically people getting into this space, they're testing the waters, they're preparing themselves operationally. There's a bit of inflation hedge, but also there's relatively attractive yield generation opportunities in the light of basically how difficult it is to kind of make money in the money markets. At the moment, when you walk, your explanation around how you deal as a corporate treasurer was interesting because it very much felt every time I was listening to you was, this is how I would deal with any asset, right? I think the interesting part about it is the size, right? Because it is important in this market. These ultimately, if you think about Bitcoin, the asset class, while it looks big, is actually quite small in the grand scheme of things. So there's a bit of like care in terms of how do you expose yourself or how do you start your investments. So it's a very good learning for that. We covered a lot. I don't think we covered all, and obviously we could speak hours, about this. I know I could. But maybe just to close on this, is there anything that you thought we would have covered that we haven't covered? Anything that you thought I would have asked that I didn't ask? Just want to get like your parting comments on this.
Oh, absolutely. And first off, that's an excellent summary in terms of our conversation just a second back. In terms of what I want to basically anchor or just put a note of reminder, what we're experiencing in digital assets is not just one more cycle of speculation and fad. I think we're seeing a fundamental shift to a much more advanced digitally native financial rails for where the world is going. And whether it's tokenization of real world assets, 24/7 operations, or like geopolitical risk hedge mechanisms, literally these seem to be the future of the finance. And especially as the world is going through this fundamental shift, it is very important for you and your organization to understand what this means to your company. And that is a place where FalconX or a provider like us, a one-stop shop, can truly be a partner in creating value for both sides. So I'm really excited for what's happening in the market and the quality of institutions coming into the space. If we could be of any help, please let us know. You can reach me at Raghu, Raghu, at falconx.io. Would be very happy to help.
It was an absolute pleasure, Raghu. Thank you very much for your time, and thanks everybody for watching. Bye-bye.
Thank you so much, Stephen. It's been a pleasure.
Bye-bye.